This video will provide a walkthrough to the solution for exercise 8.7, focusing on exchange of assets under scenarios both with and without commercial substance. Here's the data for our problem. Panera Limited exchanges two small pieces of equipment we'll call units A and B for a larger piece of equipment, unit C, from Denevy Inc. Denevy is a manufacturer of this type of equipment and classifies all of its equipment as inventory. Denevy has agreed to take both units A and B and pay Panera $12,000 in exchange for Unit C. Unit C has a cost of $115,000 to manufacture. And here's some information about the exchange that includes the cost and accumulated depreciation of Units A and B, as well as the fair values of Units A, B, and C, and the amount of cash paid by Denevy and received by Panera. There are two requirements to this problem. A, to record the journal entries for the exchange for both companies, assuming the exchange has commercial substance. And requirement B is to do the same, assuming the exchange does not have commercial substance. So let's start with requirement A, where we want to record the exchange for both companies, assuming commercial substance exists. What is commercial substance? In essence, commercial substance exists when, after the exchange of assets, a company's economic position, i.e. its cash flows, has been significantly altered. A simple example of this might be exchanging a gasoline-powered delivery truck for a diesel-powered delivery truck, where the fuel and operating costs of the diesel truck will differ significantly from that of a gasoline vehicle. In scenarios of commercial substance, assets acquired are recorded at the fair value of the assets given up, plus or minus any cash paid or received, and gains or losses between the fair value and the carrying value are recorded. So for Panera Limited, it's exchanging units A and B for unit C. To record the acquisition of unit C, which is the new asset, we'll debit an asset account for unit C for $142,000. And this is calculated as the $89,000 fair value of unit A plus the $65,000 fair value of unit B. Again, these are the fair values of the assets that are given up, less the $12,000 in cash received from Denevy. Then, after recording the acquisition of Unit C on the books, we need to remove or derecognize each of the assets that are given up. So for Unit A, we're going to credit the Unit A asset account for its original cost of $111,000, and we will debit the accumulated depreciation for Unit A of $13,000. These amounts are provided in the data and no calculations are required. We'll do the same for Unit B. We will credit the $82,000 original cost for the Unit B asset, and we will debit Unit B accumulated depreciation for $24,000. Next, we can record the cash, which is a simple debit to cash of $12,000 for the amount received from Denevy. Now we can determine if there's a gain or loss on disposal of each of the units. Starting with Unit A, we determine that there is a loss on disposal of $9,000, calculated as the $89,000 fair value less its $98,000 carrying value. This means that the value carried on Panera's books is $9,000 higher than its fair value, and that results in a loss on disposal. So we will debit a loss on disposal account for Unit A for $9,000. And finally, for Unit B, the difference between its fair value and carrying value is a $7,000 gain. The fair value of Unit B is $65,000, and it's carried on the books at $58,000. That's a gain of $7,000, which we'll credit to a gain on disposal account. And now our debits and credits balance, and we're done with Panera Limited. Now for the other party to the transaction, Denevy. It's giving up Unit C, which it classifies as inventory, for units A and B, which will be classified as used inventory. In the situation of commercial substance, the value of the inventory received is equal to the fair value of the inventory given up, plus or minus any cash paid or received. For Denevy, the fair value of Unit C is $142,000, which is what Denevy could sell it for. Therefore, the value of the inventory of units A and B brought in as used inventory is the $142,000 fair value plus an additional $12,000 in cash paid. In essence, Denevy is selling Unit C to Panera for its fair value of $142,000 and paying an additional $12,000 in cash for units A and B. Therefore, Denevy will credit sales for $142,000, credit cash for $12,000, and debit a used inventory account for $154,000. Notice that the $154,000 is also equal to the fair values of units A and B. $89,000 for unit A plus $65,000 for unit B. It's important to confirm this because the recorded value of the asset received cannot exceed its fair value. And since the fair value of the assets given up is equal to the fair value of the assets acquired, there's nothing to worry about here, and there will be no gain or loss reported either. Then Denevy will need to remove unit C from its books, so it will credit inventory for $115,000, which is essentially the cost of goods sold in the sales transaction. Therefore, Denevy will debit cost of goods sold for $115,000. Now on to requirement B, where the transaction is deemed to not have commercial substance. In essence, a situation where commercial substance does not exist means that after the exchange of assets, the company's economic position, i.e. its cash flows, have not been significantly altered. A simple example of this is exchanging a blue gasoline-powered truck for a substantially similar red gasoline-powered truck, where the fuel, operating, and insurance costs will not be significantly different. In this case, the assets acquired are recorded at the lesser of the carrying value and fair value of assets given up, plus or minus any cash paid or received. In situations of commercial substance, the transaction can result in losses, but not gains. So let's start with the journal entry for Panera. Of course, we're going to want to debit an account for unit C, but I'll leave that blank for now. A slightly different approach to take when doing the journal entries for these transactions is to get the easy items out of the way first. So first, we know we're going to have to remove any of the existing assets given up. As we did in scenario A, let's derecognize a unit A from the company's books. We'll credit the unit A asset account for its cost of $111,000 and credit accumulated depreciation for unit A of $13,000. We'll do the same for unit B. We'll credit its cost for $82,000 and credit its accumulated depreciation for $24,000. We know in this transaction, Panera receives $12,000 in cash, so let's debit cash for $12,000. And then consider if we have any losses to record in this exchange. We know that the $89,000 fair value of unit A is less than the carrying value of unit A, and this results in a loss on disposal of $9,000. We also know that the fair value of unit B exceeds its carrying value, which would result in a gain, but in situations where commercial substance does not exist, we don't record gains. So we will debit a loss on disposal for unit A of $9,000. Now, what we could do is take the difference between the debits and the credits and plug unit C for the difference for $135,000, which we can prove since the value of the asset acquired is recorded at the lesser of the fair value and book value of the assets given up, plus or minus any cash paid or received. So for unit A, the lesser of the two amounts is the $89,000 fair value. For unit B, the lesser of the two amounts is the $58,000 carrying value. And subtract the $12,000 cash received from Denevy, which equals $135,000. Finally, for Denevy, this one's pretty simple. We have to remove its inventory value of $115,000, so we'll credit inventory for that amount. Denevy will also credit cash for the $12,000 it's giving up. And to make that entry balance, it's going to debit used inventory for units A and B for $127,000, which is equal to the cost of goods sold of unit C plus the $12,000 in cash paid. And thus the new asset, inventory in this case, is recorded at the carrying value or its cost of goods sold of $115,000, which is less than its fair value, plus cash paid of $12,000.